With me is Councilmember Schneider, and I expect Councilmember Falcone any moment now. We have two items on the agenda today, the March 31st investment report and recommended operating and capital budget funding suggestions. So we'll start with that, or we'll start with the investment report. Mr. Pearson.
Thank you, Chair Horton. Councilmember Schneider. As you said, Mr. Chair, the first item on the agenda today is the March 31st investment report. It is a quarter-end report, and so I do have a brief overview for you. As we know, the economy and the financial markets continued to be unsettled during the first quarter of 2009, and it was a bit of a difficult environment within which to pursue the city's investments and investment strategy. The Federal Reserve Bank's Open Market Committee maintained the federal funds rate at a target range of 0 to 1/4%, and they reiterated that the rate is likely to remain exceptionally low, as they put it, quote, for an extended period, end quote. You know, the federal government and the Federal Reserve have been very active in both the real economy and in the financial markets, pumping money into the economy in an attempt to stabilize the financial markets and the economy as well. We did make a fairly sizable number of purchases during the quarter. Now, you're used to seeing monthly reports, of course, and now this one, just to remind you, is looking back over the entire first quarter. And the table that is shown on page 2 of the agenda report recaps our investment activity for the quarter. As shown in the table, the city invested $19.7 million during the first quarter. The purchases consisted of AAA-rated federal agency securities, of which $12 million were callable and $7.7 million were non-callable, or as we say, bullets. 17 million of AAA-rated federal agency securities were called during the quarter. It's no surprise, with interest rates being as low as they are, that many of our callable securities were called. I mean, that's when you see them called, is in a low interest rate environment. And maturities for the quarter totaled $12 million. The weighted average yield to maturity on the quarter's purchases totaled 2.527%, so a slightly over 2.5% on our purchases for the quarter, compared to that of about 4.5% on the quarter's called and matured investments. So that's important, and we're going to actually talk about that a little later when we talk about the revenue situation for the recommended 2010 budget. You can see that we essentially lost through maturities and calls investments that averaged a yield of 4.5%, and we replaced them with investments that yield approximately 2.5%. So, almost about a 40 or 45% decline in our yield on the investments that we were replacing. So that obviously is going to have an impact on our investment income, and fortunately or unfortunately, there'll be more of the same to come as we move forward, at least until we see market interest rates start to rise again.
We have a question at some point here, Bob.
Just sort of on that point, I guess now is as good a time as any to ask it. The enterprise funds borrow from the general fund fairly regularly. We've got loans out to the waterfront, we've got loans out to the airport, where we're able to get a better yield, which is important in this environment. Does it work in the reverse? Does the general fund have the opportunity to borrow from the enterprise funds in the same way that the enterprise funds have the opportunity to borrow from the general fund?
The answer, I guess, the simple answer is yes, but there are notable caveats to that. To go back to the general fund loans, really there are 3 general fund loans outstanding to enterprise funds right now. There is one to the Golf Fund, which is currently $100,000. Mm-hmm. And as I recall, they're paying I think 6% or something like
Something
that.
like that, yeah.
Then there are two to the waterfront fund, one of which dates back to the mid-'80s.
We talked about this once,
Right, and that one was to repair storm damage to Stearns Wharf, and that one actually is no interest loan. So that was a decision made back before
may
any
have
of us
been-
were on the scene
That
here.
may have been appropriate in the 80s.
That's
but,
correct. And then the other waterfront loan was for the remodel of
The building.
Yes, of the Chandlery building, and that one bears an interest rate of about 6% as well.
I was here for that.
Now, the airport one is, I wanted to mention that because technically that is not a loan from the general fund to the airport fund. Rather, we have, the council approved the airport to issue a promissory note, which we then bought directly into the investment portfolio. So it's not technically an interfund loan. It's a debt instrument that the airport issued that we bought.
That's for the rental car facility.
Right, that's
yeah,
correct.
No, that's true. That's true.
And that one, the short-term rate on the note that we have outstanding until July 13th is at 6.5%.
6.5%, right.
And the one that the council recently approved just a couple weeks ago that'll take effect on the long term on July 14th, that's for 7.25%. And
So my question still remains: does it work
Right.
on the flip side?
It does. The difference there is that enterprise fund loans to the general fund would have to be made at market rates. Now, what market rates are, there's many different definitions of market rate, but the difference is that and this has come up in other contexts recently, the difference is that the general fund as a tax-supported fund, the general fund funds can be used for any lawful purpose that the council deems. They are truly unrestricted funds. And so if the general fund, if the council sees fit to make a zero-interest loan to an enterprise fund, the council has the authority to do that. The flip side, however, is not true. The council could not decide to make a zero-interest loan from an enterprise fund to the general fund because those enterprise funds are restricted.
Understood. So to keep things moving along, I'm just going to, and you and I can talk offline
Okay.
more about this because I'd like to explore this a little bit further. The simple answer is yes. However, under certain very specific conditions, and one of those conditions is that it would not be an interest-free loan. But then again, why would we want it to be an interest-free loan? Because we want our enterprise funds to be healthy as well, so everybody gets to make money. But this investment portfolio is not the only way these monies can be used, I guess is my very simple question at this moment in time.
I'm not sure I understood the last part. These investments are purchased through the pooled cash of the city's multiple funds.
No, understood. But there's anyway.
Okay.
I'm going somewhere here, and we're getting off into the weeds, and I don't want to do that. But thank you, Mr. Chair, for the time to just get the simple question answered. Thanks.
Okay, great. Bob, please proceed.
Sure. At the top of page 3 on the agenda report, you see that during the quarter, the city's book rate of return decreased by almost 46 basis points, or almost 0.5%, if you will, from 4.038 at December 31 to 3.581 at March 31, 2009. The portfolio yield continues to decline through the attrition of higher-yielding securities, which we just saw from the maturities and purchases. And the average days to maturity decreased by 25 days from 471 to 446. We want to talk a little bit about our remaining small number of corporate debt notes. Over the course of the quarter that ended March 31, there were credit quality changes to 3 corporate issuers that we'll talk about. Well, the first is that on March 23rd, Moody's Investor Services downgraded General Electric Corporation and its finance arm, GE Capital Corp., by 2 notches from to a AA2 essentially, and that followed Standard & Poor's single-notch rating reductions from a to a AA plus from AAA, which took place on March 12th. The rating agency cited continuing concerns about General Electric Capital Corp's increased earnings pressure due to the global downturn. Both Moody's and Standard & Poor's, however, currently have a stable outlook on both of those ratings, as the agencies apparently believe that GECC will improve liquidity and leverage this year. As of the end of the quarter, our GECC holdings accounted for about 4.3% of the portfolio. So while they were downgraded, they are still a strong investment grade, Standard & Poor's AA plus, and with a stable outlook from both rating agencies. We feel fairly confident that we're okay there. And then on February 6th, Moody's and Standard & Poor's simultaneously downgraded Toyota Motor Corporation's credit ratings by one notch. Of course, automakers are under extreme pressure due to sales slumps, due to decreased consumer demand. Moody's stated that Toyota's downgrade was driven by the significantly impaired state of profitability at Toyota, due in turn to the severe nature of market conditions surrounding the global auto industry. Standard & Poor's did note that the ratings could come under further downward pressure if deterioration in the business environment continues for an extended period, or if the company is unable to maintain its ability to keep cash flow and cash positions within appropriate levels. Standard & Poor's now has Toyota at a AA plus, which again is a solid investment grade rating, and we currently hold a $2 million Toyota Motor Credit Corp note, which represents about 1.2% of the portfolio. Third and lastly, Moody's twice downgraded Wells Fargo Company during the quarter. On January 6th, Wells Fargo's senior debt ratings were cut 2 notches by Moody's from AA1 to AA3, and the downgrade was attributed to concerns regarding the acquisition of Wachovia and the inherent risk of losses stemming from Wachovia's loan portfolio. On March 25th, Moody's cut ratings on both Wells Fargo as well as B of A, citing concerns that they would need additional capital from the government. Moody's stated that Wells Fargo capital ratios could come under pressure in the short term. Moody's expects that any government support would be favorable to senior bondholders. Senior bond debt was cut 1 notch from AA3 to A1. We currently hold $4 million in Wells Fargo notes, which represents 2.44% of the portfolio. I should point out that that on the Wells Fargo, we have the 2 pieces we have, they're $2 million each. One of them matures in August of 2010, and the other matures in January of 2011. So we are actively looking for an opportunity on the Wells Fargo pieces to sell those. We don't feel uncomfortable at all about holding on to either the General Electric Capital Corp or the Toyota Motor at this point, in part because one of the GE pieces matures this June, and so those will be coming off the books anyway. We continued at March 31st to reflect an unrealized market gain because of the low interest rate environment. The market rates are below what our average portfolio yield is, and therefore, because of that, we have a unrealized market gain of almost $2 million at March 31st. The table at the top of page 5 reflects the 5 securities with the largest percentage of unrealized losses, market losses, at March 31st. And I want to stress that this is simply because of the interest rate environment and the interest rate at which we bought them compared to market rates, as well as the rating situation on the corporate notes. I point out that the market losses range from a low of $9,000 now. These are on $2 million pieces. That the market losses range from a low of $9,000 to a high of almost $16,000. So again, on $2 million, those are not consequential amounts. And of course, as always, we hold them to maturity. We don't realize any losses. We then, on the middle of page 5, we do show you the two pieces that had percentage loss during the quarter of more than 1%, and you can see that it's about 1.25% on one, the General Electric, and about 1.75% on the Wells Fargo. And as always for the quarter end, we have attached also our fiscal agent investment schedule, which we do once a quarter, which reflects the bond monies of the cities that are held by independent fiscal agent banks on our behalf. So that concludes my presentation.
Thank you for that. And I think that obviously the market situation has impacted us in ways that we wouldn't have thought about before. Question or two, Ms. Falcone.
Thank you, Mr. Chair. Mr. Pearson, you said something just a moment ago that caught my ear and I think bears repeating and clarification. You said that you were explaining where these bond revenues would be should we cash them. If I get this wrong, you'll correct me, I know. I hope. If we cash them out now, the market situation will have XYZ impact, at this point, all down, to the tune of the numbers that you just went through. However, you followed that up by saying that if we hold all of these instruments to maturity, then we will not suffer any losses. I would very much like you to say that again and to explain it in some detail for me and folks.
Okay, I'd be glad to
Thank
do
you.
that, and you're absolutely right with your comment. I use the Wells Fargo pieces as an example. They are face value. We have two Wells Fargo bonds that we've bought. Face value, each of them, $2 million. So we'll take a look at one in particular. Its face value, as I said, is $2 million. I'm on actually page 4 of the actual investment portfolio listing, the very next to last page. In fact, yeah. If you look at the corporate / medium term notes, and if you look down at the very bottom, you'll see Wells Fargo. We purchased it. It's on October 10th, 2006. It's the stated rate on the bond is a 4.625. Because of when we bought it, we're actually earning 5% on it. $2 million note. At March 31st, the market value of that note was $1,975,000, essentially. And really what that means is that that if we were to have sold that on March 31st, that's what we would have gotten from it, and we would have lost effectively $25,000. However, we didn't sell it on March 31st. And that is a market loss, which is a reflection of changes in interest rate only. And so as long as we hold it to maturity, and in this case the maturity is August 9th of 2010.
2010, right.
So about 15 months from now, we will get our entire $2 million back.
Regardless of what the market is doing at that moment in time.
That's correct.
Okay, so that needs to be very, very clearly set forth because we have the ability, whereas a lot of homeowners don't, a lot of public or private industry folks don't, we do have the luxury, if you will, of really holding all of our bonds, all of our instruments to maturity where we get the guaranteed payback, a guaranteed promise of whatever it was that we bought into, regardless of what the market is doing. Is that a fair statement?
That's an absolutely perfectly accurate statement.
Great. That's good to know. Thank you.
It is, and I just want to add to that, because probably confused them, no, is that our investment strategy has always been what is called buy and hold. Larger municipalities, City of LA, Long Beach, others, they actively trade. They have full-time investment staffs that buy and sell and don't simply hold them to maturity. Our strategy, as is the case with, I imagine, with virtually every medium to small size city, is buy and hold.
So just to recap and put a fine point on it, when folks take a look at these reports for the investment portfolio, although it may be reflecting a loss at this moment in time, unless we are forced to cash it out because it has matured, we will not realize that loss. Or we won't realize the loss anyway, because if it's matured, we're getting our promise.
That's correct.
Okay, so even though there are bracketed numbers in these reports, it doesn't necessarily mean that we are suffering that loss because we are holding to maturity, and therefore they have to make good on their promise to us, which is the full
$2 million.
amount.
That's correct.
Okay, good. I think that needs to be set out very clearly. Thanks.
Okay. You want to explore that further? Or
No.
Let's see. Question, Ms. Snyder.
Thank you. On another topic, you mentioned a number of these notes are becoming callable, or they're due, and so we'll be forced into purchasing something else at a lower interest rate than what we're currently afforded now, because when we bought these a while ago, the interest rates were higher. So can you remind me, in terms of more long-term interest income in the next budget or beyond that, what the difference is between what we expected to see in terms of interest income versus what we'll probably see, because we're going to be forced to buy additional notes because the current ones are becoming due?
Mr. Chair, Councilmember Schneider, yes, we can do that. In fact, we came today prepared to do that.
Okay, is that part of your next item?
It's part of my revenue
Okay.
presentation.
All right.
And absolutely, we've got information for you all on that exact point.
Great. And then just a final, I think when we approved the airport promissory note, it was in April. Was it in April? Because I'm seeing the...
It was in April.
Okay, because that's why the March 31st still has the June 30th date.
Actually, just to be clear, Council took a couple actions. One was to extend the existing short-term 6.5% note,
Right.
to extend the maturity date on that from June 30th to July 13th.
Right.
So that will be reflected.
In the April monthly report.
Well, it actually
I saw 6:30 as part of
yeah,
the...
we have not. Yes, exactly. That
Right.
the extended maturity date to July 13th absolutely will be reflected with the April report.
Right. And
Yes.
then after that, we're moving
then
it into a long-term...
Starting in July,
July
you will see it.
14th.
Yes, absolutely right.
Okay. With that,
Okay,
I'll move this item to the consent
Okay, there's a
calendar.
motion. Is there a second?
Yes, I'll second it.
Okay, further discussion? Hearing none. All those in favor, please say aye.
Aye.
Motion carries. Thank you very much, Mr. Pearson.
Thank you, Mr.
On
Chair.
to the next item.
Yes, indeed. On to the budget item, which is, as you know, the fiscal year 2010 recommended operating and capital budget is the item topic, and today we're going to present to you information on two areas. One is a more detailed look at some of our revenues, and then secondly, Mr. Samario is going to go over for you, give you an updated look, well, I'm not sure updated, but a renewed look at the status of our reserves, including general fund. So with your permission, I will start with the revenues. And did they? Yeah. Okay. Thank you. Thank you, Jill. So what we're going to do is look at a number of the city's key revenues. Now, I know very well that much of this you have seen before. I believe we do have some additional information for you. I also think that even some of the information that you've seen before bears further review. I mean, it's just it is the issue with which we're dealing with this fiscal year as we look forward to preparing and considering the recommended 2010 budget. So the first sheet is something I think you're probably familiar with. There was a version of this in my budget presentation, the kickoff presentation last Tuesday, but I do want to just go through this a bit. You see that, just to orient you, we've got the fiscal year 2008 actual numbers, and then we have fiscal year 2009, both the budget and the revised year-end estimates, and then we have the fiscal year 2010 numbers that are included in the recommended budget. So if we'll start with sales tax, you will note that the budget for this fiscal year 2009, that is $20,434,000. We only needed, we would have been able to decline 0.3% from '08 to make that number. However, as you know, at this point, we are now projecting a 7% decline in sales tax revenue this year, leading to a projected unfavorable budget variance on sales tax this fiscal year of some $2,043,000. And then for fiscal year 2010, we're actually projecting a further decline in sales tax revenues year over year of 1.4%. And that left us a variance to our multi-year forecast, which was the basis of the original 2010 projections, of some $3.1 million. Now, I want to stop there and look into sales tax a little more deeply. If you flip the page, what you will see is, and I mentioned this last week to the full council, you will see a letter from the State Board of Equalization dated January 16th of this year, and it's passing along to us the sales tax estimates quarter by quarter, because as you well know, our sales tax is by quarter. The statewide State Department of Finance projections for sales tax growth out through the end of fiscal year 2010. So you can see that the first grouping you see is for January. It starts January, March 08, and then the bottom of that grouping ends October, December 08. They've arranged them by calendar year. Obviously, those numbers we already have in the bank. We don't yet have the January to March numbers, and we won't have those until about the third week in July. But the state is projecting that quarter, which is now in the books, but we just don't know what it is or was, they're projecting a 7.4% decline year over year for the March 2009 quarter. Then for June 2009 quarter, 8.7% decline.
Quick question.
Yes, sir.
You have October, December quarter still as an estimate.
They do.
They do.
Yes.
But we have them.
Yes, we do.
Is that 7.1 listed on this sheet? Was that accurate?
For statewide, no. It was, as I recall, it ended up being worse than that.
More than the 7.1
down more than
negative.
7.1. I didn't bring, unfortunately.
That's okay. I'm just wondering
that
whether or
one
not
sheet.
that's a reliable number.
Well, it's the best. Nobody has their crystal ball, but
No, but that one's in the books.
Yes, it is, and my recollection is that the statewide result was worse than that. It was, I think, somewhere in the 8% down, so it wasn't off that badly.
That was my point. How in the ballpark are these numbers usually?
I think that that in this case it was reasonably close, considering.
Have you typically followed?
No, we typically have not followed these numbers.
That's what I was recalling.
That typically we have not, because typically we have not necessarily reflected the statewide numbers that this represents.
Right.
We are this time, and this is why I wouldn't go and include all of this data if, in the end, what I'm going to tell you is that for the first time in my memory, we are using these state numbers in our projections for next year's sales tax revenues.
Okay.
Just to follow on that, you have done a comparison. In other words, how realistic are these numbers historically to what actually ends up happening on the statewide level? So, I mean,
Yes.
I'm trying to get a gauge for,
Yes.
do we don't normally rely on these numbers because we probably do better than they do.
That's correct.
But, I mean, we don't have, garden spots, all over the state, and so it drags things down. But how reliable are the numbers to their own projections?
I would say, Councilmember Falcone, I would say that on balance, they are reasonably good at projecting. Now, there's always a variance, but and we frankly, in this case, could not arrive at any other projections that we thought made more sense than this. So for this fiscal year, the balance of this fiscal year, they are projecting that the March quarter will be down 7.4 and the June quarter will be down 8.7. Then we start into fiscal year 2010 which is the July through September 2009 section or line. They're projecting that will be down 5.1%. Then the Christmas quarter of 09 down 2.7%. And then the first two quarters, March and June of 2010, which is the balance of the fiscal year, down 0.1% for the March quarter, and they're actually projecting a turnaround so that the June quarter in 2010, they're projecting would be up 3.1%. And if you look at the trend, starting with that 8.7% decline for the June quarter, which will be the last quarter of this fiscal year, you can see that essentially what they're projecting is that the rate of decline will decline. In other words, that the sales tax revenue situation will start to stabilize.
That's a good double negative.
Yes, it is, for once. And that by the end of the fiscal year 2010, the last quarter, they're actually projecting that we will have turned the corner and be starting to grow again. So if you look then at the next sheet of paper, which is now into our numbers, you can see that in yellow, we're looking at by fiscal year now, and you can see that for the March quarter, we have plugged in the down 7% number, and that for the June quarter of this fiscal year, we have dropped in the minus 8.7% number right from the state's estimates. And then we took the state's estimates for all of 2010, and you can see by quarter there. And even though it doesn't seem like it would, it actually results in a total decline for the year, projected decline of 1.4%. And as you can see, that's in some measure because of the unbalanced situation in terms of the income for the various quarters. But that is down 1.4%, and that's where
way off on 2 quarters, and then not so bad.
Right.
Yeah.
So, are there any questions on the sales tax piece? Okay, then if we could go back to the summary page up front.
Just one other point on that. You and I have talked a little bit about the components of the sales tax.
Yes, sir.
And I don't really have a good feeling for how that compares for our city versus others. Like, for example, automobile sales as a percent of sales tax. They could be that our ratios may be a bit different than the statewide averages on that.
That's absolutely right. That's a very astute comment, because certain cities rely heavily on auto sales with their auto malls, and others
almost totally.
Right, and others, fortunately, ours is not a huge piece of it. It's what do we say? I think about 10%.
Yeah, we just looked at that.
Yeah,
around 10%. We have another question.
Thanks. Could you put the previous page on, please? I'm noticing there's not a match in the March 31, I guess, 09, where it says 7.0% in the yellow, whereas in the letter it's 7.4%. So
yes,
up there it says 7.0%, the March 31.
7.4.
It says 7.4 in the
Right,
letter.
and the reason we went with 7.0 is because, and we're going to talk a little bit more, in fact, I'm not done talking about sales tax, but the reason is because, as I think you'll recall, the way it's really kind of difficult, the way the state pays us sales tax is they make an estimate and then they advance us money through the quarter, and then we don't get the true cleanup until a quarter later.
Okay.
They are advancing us this quarter, the March quarter, I should have said. The March quarter, they advanced us based on a 7% decline. So they...
So you're just using the more accurate...
The more recent...
The actual number, the actual amount they gave us, as
That-
opposed to something that was sent to you in January.
That's correct.
But then you're using their estimates for the rest of this letter.
That's correct,
Okay.
because we don't
All right.
know what they're advancing us yet for
Right.
the other quarters.
Okay, that makes sense.
I did want to, and this is at the risk of getting into accounting 301 here, which I'm not intending to do,
Good, because there are reasons that some people are accountants and some people are lawyers, So.
is I did want to just sort of let you know that we are proposing a change to the way we account for our sales tax starting this fiscal year. And again, it's the problem is this, that again, it relates back to the way the state pays us sales tax, is that they advance us, and then 3 months after the quarter closes, they true it up, and that's when we finally know what we were for the quarter. So if we take the June quarter, which is the fiscal year end, last quarter of the fiscal year, normally what happens is, up until now, the way we've accounted for these is the 3 monthly advances they give us in April, May, and June, we account for as money for that fiscal year because we receive it within the fiscal year. We don't get the cleanup payment until the third week in September. So traditionally, that cleanup payment has fallen, accounting-wise, into the new fiscal year. And because cleanups are really volatile, because it's not just how you did in sales tax, it's how you did compared to what they advanced you. And if their advance happens to be off, right, then we can end up with a cleanup payment which either turns out to be this windfall, so to speak, or can be puny if they over-advanced us. And that sets us off. That becomes the first sales tax payment in the new year and can really skew the reporting for the rest of that whole fiscal year. And you can actually see that if you look over the last couple of years, what we're proposing to do, and we've already checked with our auditors on this, is despite the fact that that cleanup payment is not received until the third week in September, we're going to back it into the prior fiscal year where it belongs. And therefore, we will from now on be able to look at actual quarterly data without having this funky split within the fiscal year. And I just wanted to let you know that, and we're real happy about that. And our auditors have said, yeah, other cities do that, so you can too.
Yeah, I just, in looking back in history, though, it's going to skew things a little bit, isn't it?
Well, from a presentation standpoint, we will restate all of the prior years. So that when we bring you sales tax schedules in the future, then we look at fiscal years, we will restate them all.
Yeah, it needs to be apples and apples
Yes.
when we see it. Otherwise, we're going to be kind of confused.
Yes, absolutely, and we will not let that happen.
Well, and that will certainly help when you have the actual numbers for the budget. Because we usually in the first quarter of the new fiscal year look to see where did we end up with the budget, because that helps us with the baseline for the
Absolutely.
next year. So that makes a lot of sense. Because did we actually end up with a balanced budget or a surplus, or are we using reserves? And so that piece of the money
Right.
needs to be in the right place.
That's exactly
that
right.
makes sense.
Okay, so that does conclude my sales tax portion. And
All right, property tax.
If we go, yes, property tax, again, you can see that for this year, we needed 3.9% to make budget. We're actually estimating to fall just slightly short of that with 3.2% growth, which would leave us about $141,000 short of budget. Not a material amount on a $23 million budget. We are projecting a 3% growth for fiscal year 2010, but that still left us about $378,000 short of our original multi-year projections. Now, if you go past the sales tax pieces, you'll come to a schedule on property tax, a detailed property tax schedule. These essentially are, I've given you essentially what we at a staff level use as we make our projections and look at things. And it's nice, I think, because on the left-hand side, you've got the actual sales tax or property tax numbers going back to fiscal year 2000, nice historical record. You've got the 2008 actual, which we grew 6.6%, and then the current year budget, the budgeted growth and the growth percentage. And then on the right-hand side is the current year revenue analysis, where you see the almost $3 million of property tax plus the supplemental airplane interest and other payments within the property tax of about $1 million, and then a deduction for the administration fees that are charged to us by the county. One of the things is that admin fee from the county has been going up dramatically. It goes up and it goes down, but it seems to always trend upward. And in fact, this $416,000 is a substantially higher number than it was for fiscal year 2008.
Is there a formula to calculate that?
They provide us one, and if you have a PhD in understanding.
Kat Geis give you the Cliff Notes version of it?
No, then we might be able to challenge it. It's
It's my understanding that the county has reformulated, let me put it that way, all of their accounting fee calculations for all kinds of different departments, and this is just one.
that's absolutely right.
Yes, I know.
That's absolutely right. And it tends to happen when times get tough.
They've been doing this for the last 3+ years.
That's true.
Yeah.
That is true. And then if you add in, as you recall, the state took away our vehicle license fee money and replaced it with property tax, an equal amount of property tax. One of the few times where we really did sort of come out even on it. And then that's $7.2 million, so it brings our total estimated revenues to $23,165,000. And then below is the kind of scenario planning, what ifing that we do at a staff level when we look. And so we start with the year-end estimate for the current year, and then we look at various projected growth rates for next year. And in this case, you can see we looked at everything from a low of 2.2% growth to a high of 4%, and we came down in the middle with a 3% growth rate. Now, if I flip the page one more time, there was a question, I believe, maybe last week at the Finance Committee or Council meeting about supplemental property tax. We do have some updated information for you. Jill was able to go on the county's website today and look at our property tax account at the county. Nice feature that we're able to do that. And she did see that there's $53,704 of supplemental property tax sitting in our account there, and it'll be paid, Jill, next week or within 2 weeks? But that's what's there. So it brings our current year supplemental property tax to $356,000. As you see below that, we need, based on our projections, $500,000 of supplemental to make our projection, our year-end projection for total property taxes. Actually, we are pretty much on track to do that because, Jill looked at it, and in past years through March, we have traditionally gotten about 70% of our total supplemental through March. And actually, if you take what we've received through March, April here, and you say, well, if that's 70%, what's the total? It actually comes out to be about $509,000. So we're I think right on track for that. You can see though that property supplemental over the years has varied dramatically from a low of about $480,000 back in 2004 to a high of $1.3 million in 2006. So we feel that for this year we're going to make the $500,000, and that is upon the basis upon which we made our year-end projection. Okay, back to the original sheet. TOT, transient occupancy tax, our bed tax. You can see that we needed 3.1% growth to make budget this year, but we're now projecting to end the year down 4.9%, which will leave us about $1 million short this year. Next year, we're actually projecting to go down year over year 2.2%, which would leave us short about $1.8 million from our multi-year forecast projection. As I mentioned last week, our actual forecast for next year in bed tax was down 3%, but we added in $100,000 of additional revenue to reflect our best guess, really, and it is that, I wouldn't even call it an estimate at this point, of what might be recovered in additional bed tax from vacation rentals, from enforcement of the bed tax on vacation rentals. And that lowers the decline from 3% down to 2.2% down. And we do have one sheet on TOT. And you can see, again, the similar format. You see that historical numbers going back to 2002. One of the things I'll point out is if you look at fiscal year 2002, which was the year of 9/11, we were down 3.3%. But then if you look at the table to the right, you can see that even though we're projecting to be down 2.2% for next year, that wasn't a sort of blanket one number for the entire year. We actually looked at month by month and tried to do the best we could on that. I mean, we temper it with, well, what does it come out at the end? And we felt that the 3% decline was probably reasonable. We are looking at, if you look at the April, May, and June of this fiscal year, the last 3 months of this fiscal year, we're projecting to be down about 6%, 5.9 for each of the 3 months. Coming off 20 and 24% declines, we'll certainly have to wait and see whether it stabilizes as quickly as those numbers might suggest. We're overly optimistic, and we'll certainly see. We will have April's numbers by May 15th or so we're really still looking at about another 2.5 weeks
Okay, we have a
before
couple
we have May
questions.
numbers.
Colleen?
April
It's
numbers.
it's such a dramatic swing. I have two questions. One, why are you being so optimistic? And two, what happened in January? That we're going down 11 in November, down 10 in December. I thought it was actually +1, but I guess it's down 1.6 in January, and then down 20.7 in February, down 24 in March. What is January all about? Is that the film festival?
Yeah, it is.
It was the film festival this year because it's usually in February.
Right, and that's true. It is, and that could have had an impact on shifting between January and
Because this is
February.
bed tax we're talking about.
Correct.
That means people are in town.
That's correct.
Staying in hotels.
That's correct.
Okay, so that might be the film festival.
Right.
Because it was at the end of January this year. But why down 20, down 24, down 5.9?
Yeah, and I think there's
Where do you
probably
get that?
two answers to that question. Number one is when we initially put these estimates together, we did not have both the down 20 and the down 24. And so, if you take out those last 2 months and you look at, even if you go back and look at October, November, December, January, if you take out February and March, the 5.9 down looks a little more realistic. And, at this point, I think what we're going to do is wait and see what April comes in at, and if we have to revisit it at that point, we certainly will. And you can see that if you look at 2010, we are projecting that by the second half of 2010, it'll be pretty much stabilized. And even by next June, a year from this June 2010, we're looking at even projecting a modest year-over-year increase for June. So we're sort of following the state's sales tax curve in the sense that by the second half of fiscal 2010, things will stabilize and maybe even slightly turn upward a little bit.
Another question here, Bob.
Thanks. Given that we'll definitely have April's numbers and perhaps May before we adopt the budget, if the TOT numbers are dramatically different, aka down from what you're projecting here, how does that then relate to the baseline in our 2010 budget in terms of balancing a budget
Right.
in
We
a
would
couple of
bring
months?
you a staff recommended adjustment is what we call it. And it would
Towards
mean,
the end of the budget hearing process?
Yes, and hopefully not right at the end, because obviously there'd have to be some corresponding adjustment
Right.
to accommodate that, if you will. We will certainly be back to the Finance Committee as soon as we have the April numbers, which will be in, like I said, 2.5, 3 weeks. We will definitely be back. You'll get your normal monthly revenue news email, but we will bring it back to the Finance Committee. And depending on the magnitude, we'll certainly start contingency planning as soon as we see numbers.
So it's possible that this $1.8 million budget deficit gap that we're focusing on today might slightly even change between now and the end of the budget process if this is worse than your projection.
That's correct.
Okay.
And I'm going to show you
there's,
another.
and there's a way that we're going to be able to accommodate that in the next couple of months. Because I guess at the end of the day, we want to adopt a balanced budget with all the information as much as up to date as we can have it.
That's right. And I was talking to Mr. Armstrong about this late last week, which was that I think we as staff will plan to be far more proactive in the first quarter. Normally, we start the first quarter of a fiscal year, which is the months of July, August, and September. And we watch the numbers as closely as we always do, but generally we don't recommend adjustments to the budget until mid-year. I think we will be much more proactive in that in this new fiscal year 2010 to get on things much more quickly in the first quarter if it's deemed necessary, so that we have the time to make adjustments even during the year to keep on a balanced budget track. Because it's one thing to adopt the balanced budget, but then if the revenue picture changes after adoption, we've got to keep up with that.
Right.
It's interesting
Thank you.
to those of us that attended the UCSB Economic Forecast Seminar. This trend that you're working with kind of follows what they were saying at that meeting. Is that our numbers would be a little bit different than the rest of the country and the rest of the state. Did you have a question, Ms. McCarthy?
I do. Well, in that we are legally bound to adopt a balanced budget, I would assume that the converse would be true as well. If they come in dramatically better, then we would factor those numbers in as well as quickly. And correct me if I'm wrong, but Mr. Armstrong, I believe, has given instruction to all of the departments to work up two scenarios, one under certain contingencies and one under the doomsday scenario, I'll call it. And I'm assuming this is the first of those two and not the doomsday that we're looking at today. Because if things do get dramatically worse, the departments have already, I believe, given their
Yes.
and if it's really all terrible scenario
Yes.
to Mr. Armstrong already.
That's correct, and in fact, that's absolutely right, Councilmember Falcone. There is, in addition to the budget reductions that are included in the recommended budget, departments had identified an additional $1.9 million of adjustments that are already been identified.
Right, but that's not the budget that we're currently looking at, but those contingencies exist out there.
That's correct.
For us to muse over.
That's absolutely right.
Okay. And you will factor in better numbers if they come down the pipe, right?
Absolutely. Absolutely. Be like nothing more.
We'd all like that very
Yeah.
much.
And then, Councilmember Falcone, you had asked for asked us to find out if we could look at a couple or a handful of somewhat comparable coastal tourist destination cities and their bed tax.
Right.
And we've just handed out to you a spreadsheet which provides some of the information that you've requested. Now, I will say that we don't have everything. As you can see, for instance, we have yet to hear back from Laguna Niguel or Carlsbad. We will certainly update this spreadsheet.
These are good cities, though. Thank you.
You're welcome. You can see that for year to date, we're down 4.6%. Ventura is down 6%. San Luis Obispo down 4.5%. Santa Monica down 7.3%. Newport Beach down 13.2%. Laguna Beach down 5.8%. Monterey down 1%, and Carmel down 11.9%.
Well, that's vastly different from 20 and 24. How do you explain that?
Well, we're down 4.6 for the year, and so those were comparing year-to-date totals. And
Fiscal year to date
yes,
totals.
fiscal year-to-date totals. Okay. And then you can see that in some of the cases we were able to get monthly data. For example, in the 2 months that we were down 20 and 24, Ventura, the only month we have of that is February. We were down 20.7. Ventura was down 19.0. So very comparable. San Luis was down 14.6. Santa Monica down 27.8.
So we're all suffering the same.
Absolutely.
Sort of,
Newport Beach
except
almost
Monterey is only
right.
13 down.
Right. So I think that what I've seen from this is that we're very much experiencing what most of the other coastal tourist destination cities are seeing, at least, both in terms of year-to-date. In fact, we may be doing a little better than some of them year-to-date. But even in terms of the last couple months, we're right in the ballpark.
This is really great information. I appreciate it very much.
And
Thank
we
you
will.
so much.
You're welcome, and we will get you updated.
You keep it up?
Yes, absolutely. Jill was able to make contacts with some of these some people in each of these cities, and they, of course, said, "Oh, will you send us yours?"
Thank you, Jill.
So,
Okay, on to UUT.
thank you, sir. Yes, on to UUT. And UUT, you can see that this is one of the few sort of bright spots, if you will, at least for this fiscal year. We needed 1.8% growth to make budget. We're projecting now that we'll end the year up 3.2% or about $100,000 over budget. For next year, the recommended budget has a revised estimate of $7.2 million, which is virtually identical. In fact, I think I'll see if we can balance that at some point. It's basically balanced on a $7.2 million. We're projecting a shortfall of $2,640. We're projecting growth next year of 2.5%. So I did want to, we talked this about sales tax. With UUT, it's one of the revenue sources that we are actually already considering a revised estimate for. Since the budget was put to bed, if you will, the recommended budget. We're not prepared to make a recommendation to you yet on this simply because there's time to wait for another month to come in. But if you look at, we've given it to you here, a breakdown by utility, each of the 6 utilities. And if you look at the, you see the box around the last 2 columns, I'll point your attention to the column just to the left of the box. It says proposed 2010 growth. That's what's in the budget, the recommended budget for next year. You can see that if you now look to the very far right-hand column, our updated projection for 2010 utility users tax is now about $7,105,000, which is a decline of a little over $100,000, $130,000 of compared to what's in the budget. So this is an example where if the trend continues, that we would probably include in the staff recommended adjustments a lowering of our utility users tax estimate for next fiscal year. And you see that the changes are in gas, natural gas, and that is because of the dramatic drop in the commodity price of the natural gas itself. And the other one is in refuse, which is based on what we know now about where rates we think will be for next fiscal year. So those are essentially the 2. Telephone's the same. Cable TV is the same. Electric is actually up slightly, offsetting the declines in gas and refuse. So not a material change, but I did want to show you that we are and continue to watch these things as we go.
So, just a quick question, Mr. Chair?
Please.
In refuse in particular, and I would love to get a full money in, money out, and reserve standings for that. I'm not sure I'm familiar.
The
And
solid
I'm the
waste
chair of
fund?
the Solid Waste Committee, and if I don't know these numbers, then I doubt anybody else really does. But I would like to see a detailed accounting of what's gone on in that department, because it's been up and running now for about 4 or 5 years, and things should have stabilized. I know we're changing the rates, but I need to see that. But that aside, could the decline in refuse not only be with the rebalancing of the rates, but the way we are continuing to advance the programs in recycling and disposal and all that sort of thing? Is that contributing in any way in these numbers, or does it just sort of feel good?
Mr. Samario, you have a comment on it?
Thank you, Mr. Chair. Member Falcone, I wanted just to speak to the general trend. I think what we're seeing right now is that waste generation has generally gone down with the declining economic conditions. We see that people are throwing away less, so that means that the rates, while they may be stable, that the amount of revenues that are being generated are less just because there's less trash being disposed of. So that's what I'm seeing. Otherwise, it's, things our rates have been pretty stable. They go up by a CPI every year.
So you think it's the economy driven more, and people are just buying less than it is any sort of programmatic advancement that we're making?
Yeah, and I think it's a combination of both, but I think the biggest factor is the economy. I think a couple of years ago, the total waste that was being disposed at Teguis was around 220,000 tons per year. It's now down below 200,000, so it's a substantial decline, and that could not be because of recycling programs.
Okay, thank you. Appreciate that. Mr. Pearson, anything further on UUT?
No, sir.
All right, next page.
Franchise fees. We're going to skip interest because I'm going to come back to that momentarily, but we really only have two more left to go over, which is franchise fees and investment income. Franchise fees, you can see that back to the cover page, if you will. Another one where this fiscal year we're actually projecting to exceed budget slightly. We needed 3.8% growth to make budget. Franchise fees, about $2.9 million revenue to the general fund. We're now projecting that this current fiscal year we will exceed budget by about $53,000 with a 5.7% growth rate. However, we are projecting next year to be down 0.5%, as you know. I think that franchise fees are based on gross revenues of the utilities, the franchise utilities, and with the decline in the commodity price on gas and that we are projecting a slight decline next year of about 0.5%, which is about only really about $139,000 less than what we had projected back in the day on our multi-year forecast. I did provide you with a sheet on our franchise fees from each of the franchisees, if you will, broken down by electric, gas, and cable. And you can see that, for instance, electric, essentially they pay us quarterly. The others pay us monthly, and then they true it up at the end of the year based on their actual gross revenues within the city of Santa Barbara. The last one I want to look at is investment income. If we go back to the cover sheet, you will see that investment income, we actually, we know I've gone over this with you before, we actually recognized that our investment income would be down this year. We actually budgeted for about a 7% decline in investment income. I don't think we saw the meltdown coming, and so it's now looking like our investment income will end the year down about 24% with the Fed's aggressive rate cutting over the last 6 months or so. And so we're going to end up about $250,000 short on our revenue for investment income this year. Next year, we are actually projecting our investment income to decline 41%. And that's a $668,000 hit. That's based on an actual analysis of our portfolio, and I want to show you a couple pieces of paper that will illustrate what we were looking at. If you go to the very back of the sheet, you will see an investment income sheet, which is it's this one right here. It's one page forward, yes, and it shows by month the interest income by month with a year-over-year comparison for each month. And you can see that it almost looks like TOT, that the last 2 months have been down 20% and 24%. And we're actually projecting to be down about 24% for the remainder of this fiscal year. And then you can see that the 41% for next year. Now, if you take a look at the last page on that, this is where a sort of a summary of where we begin our analysis, and we look at where are our maturities, and we look at what we're earning on those bonds, when they will mature, and we make an estimate of what we can reinvest those funds at, and then we project it out. So this is a very detailed analysis that is done by the Treasury staff, looking at the very specifics of our portfolio. The only variable or assumption is the reinvestment rate. When these mature, what will we be able to reinvest those funds at? And that's how we project them. And we really do. This is a very summary sheet. We've got actually a very detailed sheet, obviously, that we work with that go investment by investment by investment. And we drop off the matured, or if we think it's likely to be called, we will put it at the call date, going out of the portfolio, assume what we can purchase into the portfolio to offset that, and then project investment income based on that. So it's a very detailed projection.
You also base it on when it's coming due.
That's correct.
I see you have like 32.6% of the portfolio, 13.3%. Depends on when it's coming due.
That's absolutely right.
Really?
Well, just that links to the question I had earlier on today about when things were callable and how that relates to the percentage. So
Yes, and we feel fairly comfortable projecting, if it's a callable security, making a that's I better not say call too many times, making a decision or an informed judgment as to whether or not that piece will be called, and pretty much anything in the next fiscal year that has a call date, we're assuming it's going to be called.
Mr. Chair.
Yes.
Okay. To link that into the conversation that we had during item 1, that had to do with everything that we own now, that we hold to maturity, will not suffer a loss. Still a true statement.
Completely true statement.
It's what we have to reinvest, what the options that we have available to us for that money to reinvest in the market at this moment in time. I won't use a colorful phrase. I'll just say it's really bad. However, there are opportunities, as we know, to lend to ourselves in various different ways. And we are free to explore those options. Yes?
Yes.
So the market and these instruments, bonds and banks and, it's very, very secure instruments, true, but paying 1% or something, or not even, are not our only option. But they're limited options out there because we are precluded from taking any risk, really, with this money.
Right.
But that doesn't mean that this is the only option, that there are other options. And I'd like to have you maybe just enumerate a couple of them, but I'd like to explore that a little bit more.
Sure.
Because these numbers are dramatic and maybe not necessarily so,
Well, I
if we
think
get a little creative. with it.
Yeah, and I,
Not,
Council,
not risky, but
no,
creative.
I understand completely. And just to sort of emphasize the point you made about it goes back to the investment report where I mentioned that during the first quarter of 2009, the investments that matured had an average weighted yield of 4.5%, and we replaced them with securities that had an average weighted yield of 2.5%. So that's, I think, to what you're referring. I would say that the airport promissory note, that has been factored into. Now, keep in mind that the investment earnings on this portfolio are allocated back to all of the city's funds based on their respective relative cash balances. So the general fund maybe represents now about 40%.
Sure, it's all
maybe.
pro rata, and some
Correct.
is general fund and some is enterprise
That's
fund.
correct.
So you have to parse that out when you
Right.
do the calculations, sure.
Yeah, the only thing I think, and there may be other options to be creative in a very safe and secure manner. The one cautionary note would be that, like the airport promissory note, one of the things I was careful to point out to you on that before asking you to recommending that to you and asking you to decide is it's the issue of liquidity, which is that while we can certainly in a $165 million portfolio afford to tie up 20, 30, maybe even $40 million of it in illiquid assets. Now, illiquid does not mean unsafe. Illiquid simply means we would not be able to convert them to cash on a very short-term basis.
Well, these we can't either, quite frankly. I mean, if we hold them to maturity, these are years out. They're not 15 or 20 years out. They're maybe 2 or 3 or 5. The only thing that's liquid really is the money in life.
Well,
and we can set our own terms if we lend to ourselves.
That's absolutely true. I would say only that you're right to reiterate what I'd said earlier, which is that we buy and hold. But the fact of the matter is that if push came to shove, we could sell these. Now, we might have to sell them then at a loss, but we could sell them and convert them to cash. Whereas if the loan to the airport fund, for instance, the promissory note, we would be unable to sell that on a market. It's not a marketable security. So, and I don't mean to discourage your suggestion because I think, it's a reasonable one. I just think that there would at some point be a limit to how far we could go with that. And I know that you had not suggested.
Sure,
I know
understand that.
So.
Do you have further workforce today, or did you want a recommendation on that?
Well, no, on the investment report, I'd take a recommendation.
I think we
if
already
didn't-
voted on that
okay,
one.
and no, on this one, this was for information only. We do
Information
have, I'm afraid, a little more information on reserves. Again, most of which you've
Okay.
seen, and so I don't think it'll take more than, yeah, that. What did he say?
Okay, status of reserves.
Okay, thank you, Mr.
Mr.
Chair, members of
Smail.
the committee. Yes, as Bob indicated, Mr. Pearson indicated, we are going to go through the reserves for not only the general fund, but our other funds, our special revenue, enterprise, and internal service funds. And there is a schedule up above which summarizes those. A lot of numbers, I apologize. What I wanted to start with is just, there's a lot of confusion about what is a reserve, how are they measured, all those things. And I wanted just to start with a few comments on what it is, what it represents, and how we measure it. You'll see that at the far right column of the schedule, the heading on that column is called total fund balance. And fund balance is a key term. We don't refer to it as reserves, it's fund balance. And that's a term that's unique to governments, whether it's a local government, county government, state, or even federal government. Fund balance is unique to governments. In the private sector, it has other terminology, but in concept it's the same. It could be considered stockholders' equity in the corporate world, or retained earnings, or if you own a small business, it's owner's equity. And for us individually, as personal individuals, private individuals, we have our personal equity. But it means the same thing. It essentially represents your assets and minus your liabilities, what you own or owe, what you own minus what you owe. And if you look in terms of a balance sheet, whether it's the city's financial statements on the balance sheet, you look at all their assets, all its assets, and you reduce it by all its liabilities. And that is how you mathematically calculate what fund balance is, assets minus liabilities. Now, when you look at the general fund, it's a different kind of calculation only because of the types of assets that are included in the general fund compared to the enterprise funds. And we'll talk more about that. But enterprise funds, as you know, are sort of operate more like the private sector. So their assets are substantially different than what we're measuring. They have a lot of capital assets, whether it be equipment or machinery or buildings, where in the general fund or other governmental funds, we don't include those in the calculation. They're not even counted in their balance sheet. So, and we'll talk more about that. But so the fund balance calculated assets minus liabilities, but it's intended to measure essentially the financial health of an organization or of a fund. It's the more net assets you will, if you have, the better financially you are, healthy you are financially. And what even rating agencies look for to see is not only what that balance is, but how does it change over time? Is it going up? Is it going down? Obviously, if it's going up, that means that your health is improving. If it's going down, that means that it's declining. So that's kind of what fund balance is. And again, it's different for whether you're looking at a general fund versus a enterprise fund. So you could see that the columns, there are the first 5 columns of numbers represents how we kind of categorize that total fund balance at the right. We have different categories. And the first category we've called designated. They're designated either by city policy, council resolution, or by management policy. And we, as you know, one of the biggest categories within that is what's been established by Resolution 95-156, which was adopted back in 1995 by council, which established three designations of our fund balance. The first is for disasters, which is set at 15% of the operating budget. The second is the budgetary reserve, which is at 10% of the operating budget. And the budgetary reserve is distinctly different from our disaster reserves. It's available for one-time kinds of costs, but to respond to mostly economic changes or other unforeseen circumstances. Disaster reserve is, again, for disasters, whether it be an earthquake, a flood, or those kinds of events. And then we have the capital reserve, as we'll talk about later. It's different for the general fund, which is fixed at $1 million, than it is for other funds. And then there could be other designations, but outside of that city policy, 95-156, there could be others, but those are the 3 primary, or the 3 designations per the policy. Now, to the right of that, you'll see there's a column entitled reserved, but not spendable. Those are part of the fund balance, but they're not spendable. They're not available for us to appropriate for whatever reason. Primarily, in most cases, at least for the governmental funds, it includes encumbrances. Those are funds that are kind of designated or reserved either because we have an outstanding purchase order or outstanding contract at the end of the year that those funds are obligated. So we can't count those as being available. They're part of the calculation, but they're not available for us to spend because they'll be spent in the next year.
Yeah, they're already contractually obligated.
Exactly. That's
Yes.
exactly
But,
right.
but to say that they're not spendable is not correct.
Not spendable. Yeah, probably not a good term, but not spendable as of June
Because
30.
they are spendable.
But for a
they're just
specific purpose.
spoken for.
Yes.
Yeah.
So you might want
Yes.
to change
yeah.
the verbiage on that.
And that's exactly true. We measure things as of June 30, so you're absolutely right, but at June 30, they're not considered spendable. They'll be spent next year.
You could say they're appropriated for a specific item.
Right. And then the column to the right is what we've always kind of termed as amounts above policy. They're neither designated by management or council, nor are they reserved, or they're contractual illegally, and so they're available really for appropriation for new things. Again, one-time kinds of programs or costs. So those are the categories. So with that, what I want to do is just kind of highlight some of the individual funds and fund types, and just talk about some of the key points about them. And we'll start with the general fund, of course. You'll see that their total fund balance is about $22.5 million at the far right. Almost $18 million of that is designated pursuant to city policy. $16 million roughly is for our disaster reserve. $951,000 is how much we have currently available as of June 30, 2008, in our budgetary reserve. Now, as you know, that should be close to about $10.5 million, but over the last several years, those funds have been used for a variety of purposes, primarily in response to the economic downturns, to help balance our budget. But in any case, they are now down to less than $1 million. And then I mentioned the capital reserve, which really has very little meaning now. It was established back, 13 years ago, 14 years ago. But it's just a fixed amount of $1 million that it was intended to be used for cost overruns and capital programs of one time in nature.
Our task force report covers that and suggests that we handle that differently in the future.
So obviously, if we are below where we need to be in our policy reserves for the budgetary reserve, then it makes sense that we would have no reserves above policy. That's why it's a zero number there. We do have some reserved portions. Again, primarily it relates to encumbrances at year end, contracts at year end, but it also includes such things that are assets that are long-term in nature. As you know, we have some long-term receivables. We have some notes receivable from the waterfront, for example. Those funds, while they're part of our calculation of fund balance, we really couldn't appropriate those tomorrow unless we were to call that note due. We consider that really unavailable and for appropriation currently. At some point in time, to the extent they repay those loans to us, they will become available, but just not currently available. So in this, sure, and that's true. And included in those loans receivable, as we know, we have an MLAP program, Employee Mortgage Assistance Loans Program, where we provide loans, low interest loans to our employees for first-time home buyers or purchases. And so that portion, which is outstanding, which I think is close to $2 million, is that $3.5 million? Those monies we have set aside and say we can't really appropriate those right now. They're part of our asset base and part of our fund balance calculation, but we couldn't spend that until we get those back, and they're long-term in nature. And again, unless we foreclose for whatever reason on those loans, which we wouldn't do. The next category are the special revenue funds. And you see we have the Creeks Operating Fund. We also have a Creeks Capital Fund. Our Solid Waste Fund, as Ms. Falcone alluded to earlier. Our Streets Fund, Street Sweeping Fund, and our Measure D funds, or Measure D Fund. You can see that they're not subject to our policy, the 95-156. They don't have to have any designations for disasters or budgetary reserve just because that's not the nature of them. And you can see that all their funds are either reserved and primarily for capital projects or contracts, or the reserves are above policy, which is not really appropriate terminology, but that's essentially what they're for. But in reality, because these funds are special revenue funds, all their revenues or funds are restricted for a specific purpose, such as the Creeks Fund, they in a sense are sort of designated for those purposes. So the Creeks funds could only be used for creek restoration, water quality improvement projects, etc.
Question here, Bob.
When you say above policy in these particular funds, are you talking about a 15%, a 10%, or a 25%?
Committee Member Falcone, as I mentioned, for the special revenue funds, The
There is no
term
policy,
they're
but-
above policy is really a misnomer. These are reserves that are above. Essentially, all of them are available to appropriate for whatever projects may come up. And in most cases, these funds will be used for capital projects.
Understood. But that wasn't my question. My
sorry.
question is, how do you get to the number you plugged into the column
Okay.
that is above policy? Is that based
Sure.
on 15%, 10%, or 25%?
It's really just the remaining balance. When you,
It's the
let's-
remaining, so it's not based on any percentage.
Right.
It's just
It's what's
the-
left over.
What's left over.
Right.
So it's sort of willy-nilly. There's no formula
Yeah,
to it.
right.
So above policy is also, as you just pointed out, a misnomer, just like not spendable.
Correct.
So maybe in the next version
Sure.
of this, can we correct those and make those terminologies more accurately descriptive of what the
Sure.
column
Absolutely.
and for flow?
So again, those funds that are in the available column for special revenue funds, while they're not designated for any purpose, they in a sense are, because they're restricted for the purposes for which they were collected. Again, streets funds, those are restricted for streets related projects. The solid waste fund, those reserves are related, have to be spent on some solid waste related project. The enterprise funds, you could see that they are subject to the policy. They have to have a disaster reserve, again, 15%, a budgetary reserve at 10%, but they also have to have a capital reserve that's calculated differently than the general fund. The general fund, as I indicated, their capital reserve is fixed at $1 million, where with enterprise funds, it's calculated based on their fixed assets or capital assets. It's actually 5%. The way it's calculated is 5% of either their net fixed assets or the average of the 3 or 4 years capital program. And so you can see that because they're capital intensive in nature, their operations, their capital reserves are substantially more than $1 million that we see in the general fund, at least in most cases. The water fund, for example, their capital reserve is almost $5.2 million. Now you look to the right, you'll see that under the reserved column, you see some really big numbers, which seems unusual. $109 million for the water fund, $115 in the airport fund. And the reason for that goes back to why I mentioned that the assets of an enterprise fund are different than they are in the general fund. In the general fund, we don't account for all the equipment, all our buildings, all our land. We don't account for that in the general fund balance sheet. It's accounted for separately, whereas in the enterprise funds it is. So all the water lines, all the water mains, all the facilities in the water fund are accounted for in that fund. But because those assets are really they're fixed in nature and capital nature, they're not available to spend or appropriate. So it'd be silly for us to say, well, we have all this money to spend, so we have to back those out. So, really what it leaves available are those portions that are really spendable, whether it be a cash or a short-term receivable, but we have to back out all those assets only because they're included in the calculation of what fund balance is. If you look to the far right, for example, water fund, their fund balance, almost $128 million because of all those fixed assets, those capital assets in their balance sheet. So we've just backed those out and leave really the short-term assets, if you will, in the calculation. And then I'm sorry, you have a question?
I do, actually. In the water, the wastewater in particular, we've had to comply with state requirements that are not only complicated, onerous, and very expensive, but also unfunded by the state. So we've had to sell many millions of dollars worth of bonds in my tenure since we've been here, forced upon us pretty much. How much of that money is here in the what I'm going to refer to, as Mr. Schneider said, the appropriated reserved column? For instance, $109 million in the water fund. That is obligated money. Is that are the bonds that we've sold to fix to comply with the state mandates at Cater Water Treatment Center? Are those in the $109 million? And if so, then is it the total obligation, or is this year by year? Because we have to pay those debts back. So explain to me a little bit
Sure.
how that breaks out.
I guess the better way to answer it perhaps is if you look at the fund balance column, $129 or $128 million in the water fund, that represents all of their assets, including their fixed assets, whether it be buildings, etc., minus any debt that they have, whether it be short-term liabilities for payables or long-term debt such as bonds. So it's already backed out of that number, if you will, any debt that they have that's long-term in nature, whether it be the revenue bonds they have outstanding, all that is backed out to arrive at the $128 million. So it's really their net number after you back out all those long-term debts.
Okay, so the $40 million worth of bonds that we've sold over the last 5 years, those are, and one lump sum, they're all in there.
They're backed out of that number.
Okay, thanks.
Sure. So sticking with enterprise funds still, the second to the last column, the amounts that were considered to be available, whether it be above policy or otherwise available for appropriation for new projects, you can see they're pretty large numbers. I would say that essentially those numbers are going to, or amounts are going to be used for capital-related projects. And the water fund, as you know, each year they use those accumulated reserves for one-time capital programs or projects, and so that's what those will be used for. They're just not designated at this point. And they're really just appropriated when the projects come up. And in fact, I would say that for next year, 2009, a portion of those, or a fair portion of those, are probably going to have been budgeted for capital projects. And then, so moving down to the internal service funds, we have four: the intra-city services fund, which is, as you most commonly referred to as our building maintenance, or that includes motor pool, custodial communications, telephone, etc. You can see that all internal service funds are not subject to our reserve policies. You can see, though, that we do have some amounts within the designated category in the ICS fund and also the vehicle replacement. There's $75,000 that's designated for what we have called the gas buoys for the pumps. So every so often we have to replace those, and that's what those funds are for. But you see a large number in the vehicle replacement fund. That's a fund that was created a few years ago specifically for the replacement of our vehicles. It used to be that program was on a pay-as-you-go basis, and we never accumulated reserves, at least to nearly to this magnitude. But since a few years ago, we started actually accumulating the monies that we would need to fully fund our liability, if you will, for example, and replacing those vehicles. And currently that balance is about $4 million.
Question over here, Bob.
I have a question on the vehicle replacement fund. I understand that the rationale behind putting it together in the first place, but figuring out how much to allocate to it and put it in the appropriated column here is based on what our projection is in terms of actually replacing certain vehicles, right? So if I remember this fiscal year, we decided in order to help balance our budget not to purchase certain vehicles at the, to reduce the rate of replacing our vehicles than we have in the past, and we may look at that next year as well. So I guess my question is in terms of figuring out what a correct amount in this category is that is paid for by different, this money has to go into the pot through different revenue sources. The total amount is based on a decision that we're making as a city of the actual number of vehicles we're replacing. If we choose to reduce the number of vehicles we replace or lengthen the time of owning the vehicles we currently have, then we wouldn't need as much money in that account as we do now. So this number is a little different than the percentages of certain enterprise funds or whatever, because it's based on actually making a decision to purchase something or not to purchase something. Am I understanding that correctly?
Sure. It's governed by our policy in a sense for replacement.
So since there's a line of available above policy is a dash, meaning there's nothing available above policy, that is because we're making the assumption that we are going to purchase $7 million worth of vehicle replacement. Am I reading that correctly?
Actually, Councilmember Schneider, the $4 million number is the amount that we've got designated for replacement of vehicles. There isn't anything above policy because it's all accumulated for that purpose.
So then what's the difference between the 4.029 and the 7.019?
The $7 million number represents the amounts that are reserved, that are already committed for whatever, whether it be vehicles or encumbrances and contracts. Those are numbers. And
things we've already purchased.
And also thank you, Bob. And I would say the largest number of that is just like with the enterprise funds, because they do own those vehicles. So to the extent they have those vehicles in their balance sheet, that's what primarily that $7 million number is for. At least a portion of that is for, just to represent the fact that they're in the $11 million number on the far right. A portion of that is just the fixed asset that we can't spend.
Okay, so the $4 million number, that's making the decision of spending $4 million in terms of vehicle replacement.
That's correct.
So if we should decide not to or delay purchasing something over time, then that number we can change.
No, that's absolutely correct.
Okay.
I would say it wouldn't immediately lower it, but it would probably slow the growth of it. Because if we're to, for example, decide that we're not going to replace things every 7 years, we're going to replace it every 9 years.
Right. So the amount of money you would allocate to this fund would slow down year by year. The amount
that is
would
correct.
be less. That's what it is. So that means the balance of what that number is could stay in the different departments
That's correct.
in other revenue sources
That's
categories.
absolutely true.
I think
One
we have
of
a
the-
public speaker.
Yeah, one other area I wanted to point out, when we set this fund up, we had certain vehicles, for example, a fire truck that already had 10 years on it, that we had not saved the money up. And so with this fund, although it is not fully funded, we don't have all of the money we need based on our current replacement schedule. And what we've been doing really for the past several years is we had a replacement schedule, what we would call optimum, but then we look at every vehicle, and in many cases we say, you know what, even though that's scheduled for replacement, we don't need to replace it, push it out a year or two in order to try and get the fund fully funded. But it's not, if you were to take a look at what's our current outstanding liability for all of what should we have right now if saved up, we haven't saved it all up yet. And the
Okay.
way we're getting there is by
Slowly adding to the pot.
yeah, and being really being conservative. So if a sedan is 10 years old and it's scheduled for replacement, but it only has 45,000 miles on it, we don't replace it.
Right.
We wait, and then that's slowly helped us build this up. So if you said don't replace $200,000 worth of vehicles, that wouldn't really be gravy. That would just help us drop to the fund balance to help us get to that point where 10 years from now we'll actually have it all saved up.
Okay. No, and I agree that we should have this allocation. I guess
more
part
questions.
of the question is the timing of replacing vehicles and whether or not we actually buy a vehicle at all. I mean, we might even want to have a smaller fleet in the long run in certain areas, not in our fire trucks, for example, but in other areas in terms that's still a decision that we would have to make. But this number is based on where we need to get to be fully funded with the current policies and practices we have in place and our current fleet size.
Actually, I want to correct you. That's how much we have saved up to go towards replacement.
Right.
It's not what we need. We're actually haven't
This
gotten
is
there
the
yet.
savings account here.
Yeah.
Right.
But this number is not the goal necessarily.
No, it's
This
much
is what we
higher than
have
that.
on hand.
That's what we've been able to build up over the years by really what we've been doing is charging departments what we should be setting aside every year, assuming an optimum schedule, and then not doing an optimum schedule and being more conservative in order to slowly over 5 or 10 years build up.
You know,
fund
not
balance.
to get into the weeds too
Okay.
much, but to certainly get a better idea of what that means, because I know where Ms. Schneider is going, and I don't necessarily disagree, but I don't know what it means. So in other words, what I'm going to ask you for is I'm going to ask you for a list of where do you get this money from, and what are you anticipating buying it, charging the department. What departments are you charging? I assume most of them, all of them, for whatever. But I want to know what the whatever is. Now, I may or may not say, yes, buy this, don't buy that, because that's not necessarily our purview. But in order to make an informed, intelligent decision, we can't just arbitrarily say, don't spend $2 million. We need to know what that means. So if you could get us that list, and based on what you just said, I think it might be fairly easy to do.
Well, we have, in fact, we're preparing, based on your budget discussion a week or two ago, a list of what's scheduled for replacement next year. Actually,
Just next year, but
Yeah, and I think, and we can give you the full replacement schedule. And what we also have is what's scheduled for replacement and then what's actually proposed to be replaced because the fleet maintenance folks have already gone through that list and carved out probably half of what's scheduled for replacement and said, you know what, this isn't ready to be replaced yet.
well, that's more complete information that I would like, whether anybody else cares about it or not. I'd like to look beyond just next year.
We can give you the replacement schedule for the whole fleet. It's pretty voluminous. Yeah. Yeah.
Yeah, well, we can get it. Thanks.
Move along.
Okay, and so the last thing I want to mention in relation to that fund is that of the $4 million, about $1.5 million is attributable to the general fund departments. The rest of it is enterprise fund or internal service funds. And then the last thing I will mention is in the self-insurance fund, which is the second to the last line, you'll see that they have reserves that are available of about $6.2 million. That's as of June 30, 2008. And as you know, for the current year, 2009, a portion of those funds were appropriated and to be used to help balance the general fund's budget. That was one of the strategies, the one-time measures that was used. to help balance the current year. It was around $1.2 million, $1.3 million. And you might also recall that at mid-year, we used an additional $1 million of those reserves just for the general fund, an additional $1 million to help, and based on the deterioration of our revenues, to help sort of rebalance the current year.
Slip up there. You